Hello, I'm Huntsley from Livewire Markets, and this is Views from the Top, Livewire's long-form video series putting Australia's best investors in the palm of your hand, or indeed your screen. Joining me today, Dr. Christian Bayliss, the founder and CIO at Fort Lake Asset Management. Fort Lake manages some $650 million in assets under management. Christian, welcome. Good to have you with us.
Thanks, Hans. Good to be here.
Let's go through your background, if I may. You got a PhD in econometrics, you spent some time at the RBA, you managed billions at UBS. If I pass all this together, how does all this prior experience help inform you as an investor today?
Yeah, look, I think when I think about all of the years that I've been doing this and the types of roles and the menial things that I've had to do to get to the point where I am now, you know, there's a lot of value, there's a lot of learning in all of that lived experience. And I think, you know, that would be my gratuitous piece of advice to anyone that sort of embarks on a funds management career is make sure in those more youthful years, just get out and do as many things as you can do, get all of those parallel experiences that you can, because there's no doubt, you know, from my perspective, you know, in any week or any month of the year, I always find that I'm drawing on something from those earlier days. After all of those years of experience, I've realised that that it is a very uncertain world. You ultimately don't know how things are going to pan out. You've got to accept that you've got imperfect information and you have to build a strategy with airbags in it. I think that's incredibly important. What does failure look like? Always important. Don't always focus on the positive. People would say that being in the fixed income world, being the cynical asset class, but I think you've really got to devise strategies around failure and reducing errors. I think, you know, I always use the basketball analogy. If you're trying to reduce the amount of missed shots, by doing that, you'll probably get a high percentage of shots that actually go in. Your percentage from the field will go up. That's indicative of a good process. A good process typically equals a good outcome. So that's probably been the big thing that I've focused on. Be process orientated, focus on errors, focus on reducing errors, and ultimately you'll get to where you want to get to.
Errors and imperfect information is a perfect segue actually to this next question, because the thing that stands out to me about your investment philosophy is how quant heavy your approach is. So I'm curious, what does a quantitative-led strategy mean in your context, and why do you choose to invest this way in the fixed income markets?
When we started the business, we looked at it and said, well, there just isn't a lot of quant. There's heaps of quant with CTAs, there's heaps of quant in equity products. That's been done to death. But what you find in the fixed income market is there isn't a lot of quant. Why? Because we're over the counter, we've got bespoke data, it's all quite messy. But what's really changed since, I think, the financial crisis is we've moved to clearinghouses, we've moved to more liquidity, and really what that's meant is that the data quality's got a lot better, so that enables you to be more quantitative. We always say 60 to 70% of the process can be quantitative, but you can't get away from people ultimately making decisions. I sometimes call it the optimal flight path. It's telling you the place you should go, but as the pilot, sometimes you have to put your hand on the gearing stick and make sure that you're going you know, a better way or a more practical way, because ultimately you get bumps in the road, and so that's where the practitioner comes in. You've always got to have a practitioner overlay.
It's been a volatile time to be a fixed income investor. I don't need to tell you that. I was drawn to something that Gennady Goldberg, who's head of US rate strategy at TD Securities, wrote recently, and he argued essentially that bond investors have been suffering from analysis paralysis. You're reading the quote now on the screen. Because of that, and because central banks are so data dependent, it's been a really frustrating environment, I guess, for some. But I am curious, with your particular background and the way you work, what would you say to an observation like that? And I guess, how do you cut through the noise to make profits in this kind of an environment?
Yeah, well, it's remarkable. I mean, if you think about it, even if you're on the FOMC board, when you look at their historical ability to forecast what short-term interest rates are going to do, they've been out of market by plus or minus 140 basis points. So if you're an insider inside those four walls, you can't even predict 12 months ahead within 140 basis points. So you think what that means to the people outside the four walls, people like us. And it just goes to this point that, you know, we've got incredibly imperfect information. We ultimately don't know, and we've got to build strategies around not knowing. So starting at what I call the tails of the distribution and trying to reduce unforced error, as opposed to starting at the central estimate or the central point thinking that you know, is always a better way to build strategy, because it just shows you the levels of uncertainty are extreme. And when you're coming out of pandemics, when you're coming out of these crisis eras, these crisis periods, that's more accentuated.
Just to further that point along, so from a tangible, from an investable point of view, how do you reduce those unforced errors, and how do you make sure that there's less of the things that you can avoid doing that are wrong?
Yeah, well, ultimately you're trying to have a high hit rate. I mean, for basketball fans out there or tennis fans, ultimately what you want to be looking at is ratios that show your success from the field. If you're, if you look at the basketball playoffs are on at the moment, and you see some of the great shooters, who are 60, 70% from the field or from the free throw line, ultimately that's indicative of a good process, good technique, good training. We see it very much the same way. If we've got 80% positive months and 20% down months, and our 20% down months are shallow, that's telling us to double down on the process, and that's what we currently see in our strategy. And so, we want to always be trying to target a process that delivers an outcome, but being process orientated, not focusing too much on the outcome, because if you're doing things properly, that will take care of itself. You've ultimately got to dive into the areas that give you those high hit rates. And really, for us specifically, what that means is always staying close to home, avoiding unintended volatility. A specific example of that would be, don't go and buy 10-year, 20-year, 30-year bonds where you've got a truckload of volatility, a lot of uncertainty, a lot of leverage. These sorts of things are going to blow your risk budgets out. Always stay in the opportunity cost parts of the market, i.e. the front end of the curve, where you've got a lot more control. And always position the investor towards opportunity cost.
Funny you talked about the Fed not being able to forecast its own rate. Actually, no central bank really forecasting rates. How many times did we hear here in Australia, right? No rate rises until 2024. I want to bring up this second chart if I can, and for the audience who's looking at this or viewing this. This chart from Apollo Global Management shows just how wrong not just the Fed is at forecasting its own rates, but the market is as well, and has been about where interest rates are going over any one period. So with that in mind, and kind of what you were saying earlier, I'm curious, do you expect rates markets to remain this jittery for the foreseeable future? And again, what does that mean for where you invest? Does that mean you stay in that front end of the curve?
Yeah, I think, again, you've got to really approach the market with an open mind. Going back not that long ago, people thought interest rates couldn't go negative. I mean, it wasn't even in textbooks. We've got a whole different research paradigm now. And again, we're coming out of a pandemic, and the types of theories and assumptions that we live and die by might just not actually be correct. An example of that would be, has the balance of assets moved so substantially? Has the balance of savings moved so substantially that actually pushing interest rates up actually becomes stimulatory? And I think that's been a really underexplored topic. I don't think the research has been all that great. I don't see a lot of central banks talking about that novel idea or that novel approach to monetary policy. Could it actually be that cutting interest rates ultimately reduces inflation? I mean, we just don't know, because we're coming out of such a different period. The world could have shifted, and it could mean that the policies that we're undertaking right here and now are counterproductive for what we're trying to achieve. And I think that's something that we need to consider. And what it means is that we could ultimately find ourselves in quite a vicious spiral here with interest rates, and ultimately
a vicious spiral down or a vicious spiral up? Or what do you mean by that?
Well, we could be actually stimulating by keeping things higher for longer,
yep.
And we could be ultimately feathering the pockets of particularly the higher net worths who have a lot more savings and who have obviously accumulated a lot more savings on the back of the pandemic and the stimulus measures that have come about. And what we might see at the whole level, at the aggregate, that this is actually not doing what we typically would have thought. And so, the shift in the sands have changed quite a lot, and I think we've just got to be very open-minded to how this all could play out. And central bankers are usually pretty, I think, have a higher level of intellectual integrity with these sorts of things, but kidding yourself that you understand how this is going to pan out and how it's going to look in the future, I think, is a very dangerous prospect, particularly when we're coming out of such an uncertain environment.
No, yeah, absolutely. So we'll come back to government rates in a moment, but I understand you're also launching a new credit equity fund,
yeah.
Which I note in your documentation, you described it as opportunities within global credit markets with equity-like characteristics. So I'm just curious, why are you launching a fund of this style?
Yeah.
And why now?
Yeah, well, look, it's ultimately for equity refugees, as I call it. It's more an asset class play as opposed to a relative value or a relative product type of play. And really what we're looking to do there is give people an alternative outside of the equity market with similar types of returns. I always say income is effectively capital just being crystallised contemporaneously. So if you're worried about equity markets, if you want some sort of downside risk and you're in equity products, there is a halfway house, and you can go into that, what we call the credit equity part of the world. It's typically an area that requires a high level of research. It's a high value area, i.e. it's not like a garden variety bond fund. And with that, you'd expect to get pretty reasonable returns. And I think that's what we find, is that every time we feel like we move up the complexity spectrum, every time we do that, our hit rates are pretty reasonable. We don't find that our hit rates are dropping, and we're getting rewarded for moving up into that more complex area. And so that's something that we wanted to bring out and flesh out more in one individual products. The demand for it was there, and that was ultimately why we decided to launch it.
Okay, so let's put this all together then. You talked about being in the front end of the curve earlier. You're talking just now about kind of moving up in that risk and complexity spectrum, moving up the risk curve, as it were. What kinds of opportunities are you eyeing, not just for this fund, but for your other funds as well, or at least where are you finding your biggest advantages?
Look, I think really probably one of the most underpriced opportunities in the markets is giving people access to the default system. I really do believe that's an underexplored area. I think there's not a lot of intellectual research out there on that particular part of the market. It's evolved a lot over the last 10 to 15 years as a result of the financial crisis. The microstructure's changed. The ability to wrap that into financial products has changed. It's very liquid now. It's not like the old legal agreements where you're waiting 1.5 years to have a sort of a legal war with a particular issuer, and then you get your money back. This has all been standardised. It's highly effective, and what that does is it enables it to be wrapped into financial products and used as an alpha source or a return generator within a portfolio. And so you can generate returns from defaults. I always say avoidance is not a strategy. When you speak to a lot of people and you say, well, what's your views around high yields and defaults? They say, oh, we're just not going anywhere near corporates that are about to default. And you go, well, why don't you turn that into an opportunity? That can be a really good negative correlation type of investment for you, and it will perform well when your equities and your risk buckets are doing poorly. And so we think that's the way to integrate that into your portfolio. We think there's some interesting opportunities still in the inflation space, particularly around curvature and these sorts of things.
Curvature meaning what, sorry?
Curvature in the inflation curve.
Yep, okay.
You've got inverse inflation curves where high front-end inflation and lower future inflation is still there, very similar to what you're seeing in interest rate curves. All of those sorts of things can be wrapped into an investment strategy which augments your credit portfolio, cross-subsidises some of these insurance strategies. Ultimately, that's going to give you, again, low correlations to other areas of your portfolio, and we think that's where you want to be. So you want to be in that low correlation part of the market. If you can, try to devise strategies which have an anti-risk bent at this stage in the cycle. I think there's more iceberg beneath the surface than above the surface now, and you've just got to be careful about how much is under there. So really what we're trying to do with our strategies and our opportunities is more tilting towards what's underneath the surface, but trying to turn them into positives, not negatives.
Yeah, no, yeah, absolutely. Don't we all need some extra positives right now? So finally, this is the question that we ask everybody for this series. Of course, this series is all about extracting insights from people who are at the very top of their game. Christian is one of them. What is one thing you have become privy to? Again, it can be recently, but it can extend all the way to your time as an academic or even your time at the RBA. What is one thing you've become privy to that you wouldn't have realised or had access to if it weren't for the position that you're in today? Indeed, do you have a view from the top?
Yeah, look, I think probably one of the more interesting things was, I remember when we started the business, everyone said, well, if you're going to start a fixed income business, what's your point of difference going to be? And you go, okay, well, let me think about that, and then you give it a bit of thought, and you go, oh, well, maybe we should focus on these parts of the market. That seems to work a bit better for the end user. And then you get 3.5 years, 4 years down the track like we are, and then the same people that were saying that are the same people that are saying, oh, it's a bit too different. I don't understand. It's too different. And then you get almost a bipolar type of reaction. So what that really taught me was you've just got to go with what you believe, what you think actually works, and what would you do with your own capital as well, I think is incredibly important. Really get back to being client-centric. Don't navel gaze. Don't think about business. Don't think about products. Think about what actually works. Think about the end consumer, what they need, what they want, and I think that ultimately dictates pretty good outcomes.
Dr. Christian Bayliss, founder and CIO at Forte Lake Asset Management. This has been a fantastic conversation. Thanks for joining us.
Thanks, Hans. Cheers.
And thank you for joining us. If you enjoyed that interview, you can subscribe to the Livewire Market Index websites, and you can also subscribe to our YouTube channel where we have more great episodes of Views from the Top. And we thank you for watching.